Now, before we begin with each and every individual method of project evaluation techniques, it's important for us to understand the concept of present value. What does the present value mean? Present value is the sum, or you can say the current value of sum of money or stream of cash flows at a specified rate of return which are supposed to be received in the future. Okay, so it means that it is, to simply put in a layman's terms, it can be said that receiving $10,000 now is worth more than receiving the $10,000 5 years from now. Now, why does this happen? If you recollect the fact, we had an concept of inflation, right? Every year the inflation rates are going high and high and high. So it's obvious that the purchasing power of $10,000 today as on date will not be the same as of 5 years from now. If you can get a brand new 4K TV for $10,000 today, 5 years from now, it's highly possible that the cost of that same TV will be around 15,000. You can say 12 to 15,000 at least. It will be increased, but it won't go beyond 10,000. That's why it's important to know this thing. How do you compute what is the present value of my money which I'm going to receive in the future? Because if you understand the very fact, all the projects in that you're going to invest the money right up front, right? But they're going to take a good amount of time, might be 3 years, 5 years, 10 years down the line to give out a constant return. But that return which you expect to receive 10 years from now, which can be $10,000 a year, it's not going to be the same, it's not going to have the same purchasing power as a $10,000 today, right? So it's important to bring down the future 10,000 value to its present value, bring down the value. Always remember this thing, that when you're going to be trying to determine the present value of your future receipts, it's always going to be lower than what you're going to receive in the future. So let's say if you're going to receive $10,000 in the future from 5 years from now, its value as on today will definitely be less than 10,000, because it's going to appreciate to that amount to receive, to go to a level of $10,000. Okay, so that's why it's important to know the concept of present value to get a much more understanding, or you can say to make much more informed decision in any of your project selections. Let us see the formula for present value, or you can say how the computation of present value works. The formula is C1 divided by 1 plus R raised to the power of n. Now your PV is your present value. C1 is the future value of the cash to be received. Like say, you know that 5 years from now, the project is going to give you $10,000. So that's the future value of the cash to be received. The future value is 10,000. We're going to try to discount that and bring it down to current value. The R is a discount rate. Now this is basically the interest rate at which, or you can say the income rate, discounted rate, which you got expect to receive over the number of years. So every company has their own hurdle rates, which is the discount rate over here. We're going to talk about this in detail as and how we go about. But understand this thing, if a company expects that its resources generate a 7% risk-free return, so that is a discount rate over here. What is the amount of interest, or you can say the interest risk-free investment return the company expects to generate? It can also be a higher one. It's not necessary that always the company should have a risk-free one. If the company states that always all the investments done by them till date have been generating a return of 15 to 20%, so even that can be discount rate. Nothing is bounded over here. It's all supposed to be defined. So as a project manager, it's really important for you to determine what is a company's discount rate at first. Then only you can make an informed decision for arriving at the present value concept. Okay. Next is the n. That is 1 plus r raised to the power of n. That is a number of periods. Now this number of periods can be a yearly, a 6 monthly, a quarterly thing, anything. Okay. With this thing in mind, let us see a quick example. Ideally, let us prepare a quick example to understand the concept of present value. So we have Excel ready over here. Now let's say we need to compute the present value of $100,000 expected to be received after 3 years, discounted at 10%. Okay, so I'll just note it down over here. Compute the present value of $100,000 expected to be received after 3 years, discounted at 10%. Fine. Now, before you go ahead in depth of this, let's try to interpret the formula which we had used over here. That is the cash future value of the cash receipts divided by the 1 plus rate of return or discount rate raised to the power of n. So over here, if we had to replace C1 will be $100,000. That is the future present value of the future cash flow to be received. The discount rate will be 10%. and the period will be annual periods, that is going to be 3 years. So replacing this in the formula, we have $100,000 divided by 1 plus 0.1 raised to the power of 3. Okay, right. Now if we were supposed to do 1 plus 1, we'll just try to understand it mathematically. We also have an entire table, ready table available with us, but I'll show you how to read the table. But to read the table, it's important for you to know how the formula, multiplications and factors are working up here. So coming back to our example, we can say it's 1 plus 1.1 multiplied by 1.1 multiplied by 1.1. That's 1.1 raised to the power of 3, right? Now, if I was supposed to actually see the amount, it's going to be 1.331. So, putting the figures over here, it's going to be $100,000 divided by 1.331 equal to 100,000 divided by 1.331. The present value is supposed to be $75,131.48. So, to put it in layman terms, $75,131 today will be valued at $100,000 3 years from now, discounted at 10% rate. So that is how you compute the present value of the future cash flows or the future amount of money to be received. Now, I just put the equal to sign so you understand how the steps are derived. Now we did this thing with the entirely our own computation, right? We used the formula, actually multiplied 1.1 into 1.1 into 1.1. Suppose you had a period of say something around 10, 15 years. At that point of time, it will be really chaotic to multiply and determine these values, right? So that's why we already have a present value table along with us. Now this table is a standardized one. Over here you have two categories, present value and future value. We're going to focus our efforts, or you can say we're going to focus on this part of the table, present value. Not to leave you guys in suspense, I'll just give a short insight what is present value and what is future value. Present value we already covered. We're trying to determine the future value of the amount which is supposed to be received in future as on today. Like in this example over here, the $100,000 that we're going to receive 3 years from now, today its present value is $75,131. In the same way, the present future value works in a reverse order. So you know the fact that you have $75,131 in hand today. What will be its future value based on a 10% discount rate, 10% earning rate in the next 3 years? It goes the reverse way. And you also can say that the future value of $75,131 today will be $100,000 3 years from now, discounted at a 10% rate. That is an earning of 10% income on this $75,131. So it's a reverse order. On one case, you know the future value and you try to bring it down to its present value. In other case, you know the present value of the money and you're trying to determine what will be its value, appreciated value in the future, because money is always appreciating unless the economy is facing a deflation. Like you can say the value of money is going down. Okay, so getting back to a table, how do you study the table over here? So remember this thing, we had a discount rate of 10%, that is a hurdle rate of interest is 10%. So we're going to look at over here 10%. Now 10% for 3 years. So you have this over here, number of year period 0.9091, 0.8246 and 0.7513. We need the amount, you can say we need the value at the end of third year. So that is the number over here, 7513. So what this means is that $1 today discounted at 10%, after 3 years its value is going to be 0.7513. Now if we replace this 0.7513 in our equation over here, multiply this value by $100,000, you have $75,130 over here. The difference is due to the rounding of the amount, but it's approximately the same amount, right? 75,131 and 75,130. That is a difference of $1.48 only. So this is how you study the present value tables. Okay, I just mentioned over here present value using present value table. I'll give a short note. Referring 10% column, that is this amount over here, referring the 10% column, discount column for the third year, that's gonna be the present value is 0.7513. Therefore, the present value of $100,000 is $75,130. I hope you got the gist, or you got a brief summary of how do you compute the present value, what's it used, why is it required in your project evaluation techniques, and now we're going to study each and every method in depth. But again, I request you guys to go through this one more time to understand thoroughly the concept of present value. Without it, most of the future, or you can say most of the evaluation techniques which you're going to study are not going to be helpful much to you then. With this thing in mind, we complete the concept of present value and we move on now actually to studying the 6 different methods of project evaluation.